Good morning, traders and investors. Roger Scott here, senior strategist for The Trading Pub. It's Wednesday. It's December 6th. It's about 7:55 in the morning. The market's going to gear up to open up in about an hour and 35 minutes. If you haven't checked out my videos, please check out my YouTube channel. Go to YouTube, go to the search bar, go to roger-scott.com. In my videos, below my videos, you will find a link to a noon VIP room, which I'm going to be probably closing out for free on holidays, during the holidays, New Year's 2024. For now, it's still free. Check it out. The link is below this video. Also, if you don't sign up for my Telegram channel, you're missing out on some real goodies, some bonus free trades that I give all the time. Go to rogerscott.com. That's rogerscott.com/Telegram, or catch the link below this video in the YouTube channel. You're really missing out if you're not getting all those goodies. People are making money, at least for the time being. No guarantees. All right, let's get into all of the goodies. So the Dow is up 36 points. The Nasdaq is up 22 points. We've been really choppy and seeing a lot of gaps as we head up to this trajectory. Right now, the market is rather choppy, as you can see right here. We're near very strong resistance levels that have been here for a long time. Let me just take this here so you can see it right there on a weekly basis. So the question now is, are we going to break through or not? And for now, we're just being very choppy without any clear directional bias and a fairly tight range. And also, volatility is going lower. The range is not like it was 2-3 years ago. But you could see that the S&P 500 is holding up fairly well. Also, we've got earnings today on GME, Campbell Soup, Chewy, some consumer staple stocks, GME. I know folks are big on that. But that's coming out. Tomorrow we have Dollar General. But earnings are still in focus. Obviously not as much as they were a while back. The other big factor is the bond market. The bond market continues moving higher, which means consumer stocks and stocks that are sensitive to interest rates are moving higher, because if the bond moves higher, that means the labor market's getting tighter. That means inflation is moving beyond us. There's still a wacky theory that we're going to be lowering rates in March. It's over 50% right now. I think that's going to be our undoing first part of the year, but that's not here nor there. But consumer stocks that consumers buy, Nike, jewelry stores. This is why smaller cap stocks, this is why real estate stocks are going up, because bonds are going up. If bonds go up, it means interest rates go down. If interest rates go down, that means there's a tighter labor market. That means there's less inflation. That means that there's a higher chance that consumers will be better off because interest rates will be less sensitive. And that's one of the biggest reasons why you're seeing stocks like Apple, stocks like Nike, there we go, Discovery, credit cards, consumer services, see that? DocuSign, Spotify, another consumer stock, T-Mobile, consumer stock, McDonald's, consumer stock. How could I forget, right? Costco and Home Depot are travelers. Costco and Home Depot are also in that group. Leonard Home, real estate stocks. They're also very sensitive to what happens with the interest rate market. So lower rates are really good for the stock market. The problem is, I don't think that's going to continue. And I think we're going to have some more turmoil before we're here. I think we're going to have to wait another maybe 9 months to get to where we're at right now on a fundamental basis. I think technicals are running a little bit ahead of things. We've got ADP employment report. It depends. This report could be a big report when it's accurate and accurately reflects Friday's employment data, but this is a private report. It's a survey to see what the employment situation is. And if we see more job openings, that's very bad. That's inflationary, because then employees can set rates, right? And they could get whatever rates they want from bosses because there's too many jobs. But if the labor market's tightening, that means the employer is in control, which means tighter market, he can control the action, which is less inflationary. So this report will be a very good report ahead of Friday, because right now everybody's thinking inflation, which is why the bond market is moving, or lack thereof. Now, let's talk about global economy, and then I'll get into the technicals, because this is really important. And again, right now, the biggest question is what the Fed is doing, is it working, the impact of it, and how much it will cause the economy to subside in terms of inflationary pressure. So we're trending a little higher today as the latest employment data fuels bets that the Federal Reserve is going to cut rates in March. I laugh. I think that's the funniest thing in the world. Even squirrely Powell's like, well, we may still have to raise rates. We're already thinking they're going to be cutting rates. Folks, there is absolutely no fundamental indication from the Fed that we're going to be cutting rates in March. This is such wishful thinking, I can't even begin to tell you. Well, we'll see what the ADP report says, but I'm telling you right now, it's hilarious. There's a 53% chance right here that they're going to cut rates in March. I mean, don't you guys think that's wishful thinking? They're still raising, they're still evaluating the impact of it. It's a little too fast, but what do I know? Labor Department report on Tuesday showed that the job openings fell to a 2.5-year low. That's good. That's really, really good. November ISM Service Index came in at 52, stronger than expected. Lower interest rate means service sector is heating up. And service sector is 75% of our GDP. Global services came in line. So the data wasn't bad, but this whole thing with a 53 chance priced into the bond market that they're going to cut rates in March, I think that's laughable. I mean, honestly, I think I don't have to think. If you ask the Fed, what a lot of folks did, they're like, that's not what we said. That's not what we're doing. Listen to what they're saying. We may have to raise. We don't know what's going to happen in the future. We'll have to let the market decide the impact of what we've done. That's what they've been saying. And I haven't been tough on them because they've been 100% accurate. They've gone through quite a race, and now they need to see what happens. So to say that we're going to be cutting rates in March is just really premature right now. Not saying it's not going to happen. I mean, everything can line up, and it could. But to say that right now where we're sitting, that's like a kid who's sitting at home all day and asking the mom for an ice cream bar. And the mom says, if it's hot today, if it's hotter and the weather's good, we'll go to the store and get it. Meanwhile, it's raining like nonstop, like 5 inches of rain. And the kid's like, okay, thanks, Mom. Yeah, I'm going to get my ice cream. You ain't getting that ice cream. It's going to keep raining. I mean, really, folks, temper your greed. 53% as priced into the bond market, that's insane. ADP report comes out today. Non-farm productivity report comes out today. Crude oil inventories. This will give us a good idea. Crude oil's been dropping like a rock. SLB, APA, a lot of crude stocks have been dropping. Europe giving us a little tailwind amid increased expectations of a peak in global interest rates. Very possible, but it doesn't mean they're not going to stay elevated for a while. With investors anticipating the release of the ADP report, gains in mining and travel stocks, consumer. Mining, I don't know what that's all about, but travel stocks, consumer spending. China closed slightly lower. Investment sentiment remained fragile, while Moody's downgraded Chinese credit outlook. It's not looking good, and China's weighting in our sentiment. It's not helping us. Japan closed sharply higher as indication of a cooling U.S. labor market, increased speculation about a peak in global interest rates. They should have waited for the ADP report to come out, leading investors to buy back beaten down rate-sensitive stocks, which is what we've been seeing here as well. So, as I mentioned, we've got earnings today. The bond market's really high. If I show you the stock market, you could see the S&P is rather flat, but we are above the 8-day EMA, and there's a good chance we're going to start hitting the high again, or hitting this area here. Whether it breaks or not really does depend on sentiment. And I think this Friday's report is going to be very instrumental. If you look at the QQQ right now, you will see that we're sort of coming back. Remember what I told you? And this is somebody sent me an email, and they said, Roger, why are you selling puts on Meta if you expect tech to go down? And my answer was, well, it already did, and I'm not expecting it to go down to here. I'm expecting it to just cool off. Remember, we're still in December. November and December are bullish for the stock market. So I think Meta and all these stocks are going to just kind of hang out and maybe even go a little higher. I'm not seeing any major downside right now. So what I was expecting from tech, a little sell-off down to the gap right here. Remember I said we may start filling in the gap and then come back? I said it. It's going higher. It's going our way. So I'm not really bearish on tech. I'm just more bearish on tech than I am on blue chips. I think blue chips are going to be higher. But remember, if the market's up, they're all going to go higher. So again, I'm not that negative on the QQQ. I just wanted a little pullback, which we got. So I'm looking at tech stocks, chip stocks, which were already stronger yesterday, to start coming up. And if they start coming up, that means those other stocks, the consumer stocks, may start wiltering away. Let's look at the Dow. That'll give us that answer right now. Ooh, the Dow's down. It's up only 0.10 overnight, but the QQQ is up 0.17. And the SPY is up 18. So there's definitely less market cap going into the stocks that have been rising. But look at where we're at. We're still doing relatively well. Now, here's what I wanted to show you. And this is important. This will tell you a lot. If you go right here to our scan, you could see very clearly over the last 3 weeks, real estate, interest rate sensitivity, retail, interest rate sensitivity, home builders, interest rate sensitivity, Russell 2000, small caps, interest rate sensitivity, mid caps, interest rate sensitivity, financial interest rate sensitivity, utilities. I don't know what they're doing there, but because utilities with interest rates going down, utilities should actually be coming up. But I think I would expect them to be higher here. But still, interest rate sensitivity, Dow Jones, interest rate sensitivity, consumer discretionary interest rate sensitivity. All of the highly interest rate sensitive stocks have been moving higher. What about the last 5 days? Interest rate, 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 and interest rate, and still interest rate. So right here, here's all the speculative stocks, and you could see they've been coming down while interest rate sensitive stocks have been moving higher. Let's see if that can continue, because I actually think we're going to start balancing out going the other way right now. Because like today, for example, tech is starting to lead. So let's see what happens with all of these stocks. But you could clearly see right now, Shopify, Nike, T-Mobile, IBM, Spotify, consumer stocks, Costco, Royal Caribbean, traveling, Signet Jewelry, consumer travelers, consumer stocks. Anyhow, you could clearly see what's rising right now. Now, today's Wednesday, and I'm supposed to give you a long and a short. So let me do that right now. Well, I got to be honest with you. I really like Shopify. I like how it came down here and came up. Shopify looks really good. And let's see here. I like Nike. I would say T-Mobile and Shopify. T-Mobile and Shopify, because we have a little bit of technology in here as well. And it looks like technology is turning right now. T-Mobile and Shopify. And on my crappy list, let's look at the 20-week lows. Ooh. Oh, yeah. Oh, Halliburton. I wanted to do this 2 days ago, but my assistant, Matt, stopped me. He told me Warren Buffett warrants are at 58. Don't do anything, but we're below there. So Halliburton, energy's looking weaker. Energy, APA looking weaker. Ooh, China, YUMC looking weaker. Albemarle. So here's what I would do. China, win. Sell win. Win is not winning right now. And sell PLL, these two stocks. And if you get a chance, Albemarle's looking pretty crappy too. Those three stocks, China exposure and basic materials. All right. Wow, what a good session. Before I let you go, I've got an important announcement, and I've got an important goal to accomplish, and I need your help. I want to rally. I want to rally at least 100 of you to embark on an exhilarating journey with my weekly cash flow challenge. Try saying that 10 times. The mission is all about transforming you, yes, you, into my next big 5-figure success story. We're aiming to consistently snatch extra cash flow from the market week in and week out. Join me at 1 p.m. Eastern Time today for an in-depth breakdown of how we'll make it happen. I'll give you my top 5 weekly cash flow stocks. Wow. Just hit the link below and I'll catch you this afternoon right after my VIP room. It's going to be fun, 1 p.m. Eastern Time. Trust me, you're going to enjoy it. I'll give you some freebies too. Have a great day. Remember, sign up to Telegram if you want the second part of this video all day long. Sign up for my YouTube channel if you want these videos. And join me in my VIP room today at noon. Bye, guys. Have a great day. If you want, send me an email, roger@rogerscott.com. Bye.